Good afternoon, everybody, and welcome to BetaShares webinar for today. We really appreciate all the interest and attendance we have for the session. The session is about investing in tomorrow today, really a bit of a deep dive into technology investment opportunities using exchange-traded funds and the general market environment as well. We've got a few great speakers today, which include Chris Yates. He's an account manager of our advisor services team. You can see his bio over there. Also, to let you know that this particular session is general information only, so it should not be considered personal financial information or personal advice. All the products we speak about today, more information is available from us. Please do refer to the product disclosure statements if you have further information. As I mentioned before, I'm joined by three esteemed speakers today to talk about technology. The first is David Gedeon. David would be familiar to many of you who attend our regular webinars. He's our chief economist and is going to be talking about the current market environment with a bit of a focus on technology as well. I'm also joined, fortunately, by Dave Gedeon, who's a VP of Research and Development at Nasdaq, all the way from New York City. And Chris Yates, as I mentioned before, our account manager for advisor services here at BetaShares. So the three things we're looking at talking about today are really about, first of all, just given the volatility we've been seeing in the market recently, a bit of an update on the global market and the Australian market outlook from David Gedeon, our chief economist, and then some investment opportunities with a slant towards technology for 2019. Dave Gedeon will then speak about indexing in technology, specifically talking about the Nasdaq index, the Nasdaq 100 index, and cybersecurity industry. And then Chris will end up talking about some ETF solutions which are available to investors to access some of the technology exposures we've been speaking about today. Before I do start, I'll just advise, as always, this particular session is being recorded and will be sent to all those that registered at the tail end of the day today. We've also got a handout section. As you will see, there's a handout section with 4 fact sheets associated with the technology exposures we are talking about. And also, if you do have any questions, we've got a questions widget there. If you just type it in, we will endeavour to have a bit of time for Q&A later in the session. But without further ado, I'll now pass on to David Gedeon to take us through the Australian and global market outlook. Over to you, Dave.
Thanks very much, Alana. Thanks, everybody, for joining me today on what is obviously another volatile day in the markets. A lot of uncertainty in terms of what's going on, so I hope to share with you some of my views on that today. Firstly, just a bit of a backdrop in terms of where we are in terms of the global economy. As you can see, we've had basically still enjoying this long global economic expansion. Unemployment rates have dropped to pretty low levels across the major G3 economies of the US, Europe, and Japan. Employment growth has been pretty good as well. So certainly at this stage, the lead indicators are still looking pretty healthy for these economies, but there are some issues going forward, particularly if you just go to the next slide. Wages growth has started to pick up in these economies, although it is still quite low. And also, and helpfully that inflation rates in many of these countries are also still pretty well contained. So if you look at the, just on the second graph there, we've got headline and core inflation for United States, Europe and Japan. That's consumer. So core basically strips out oil and food prices, which tend to be quite volatile, and so it gives you more of an underlying feel. So inflation in the US now is back at around 2%, which is exactly where the Federal Reserve there would like it. Inflation in Europe and Japan still lower than their central banks would like, so they're still reticent to start to tighten policy aggressively, though given the declines in unemployment and the ongoing growth in Europe, they are looking to start to eventually tighten policy second half of next year. But at the moment, the main game is the United States. And I just draw your attention back to that wages growth chart where wages has started to lift. And that to me is the single biggest risk, well, not the single, but I mean the biggest risk in terms of the ongoing bull market we've been enjoying since 2009 as we head into 2019. If that wages number, which is currently about 3.1, if it does head toward 4%, over the next 3 to 6 months, then the Fed will have no choice but to continue to raise rates aggressively and potentially slow the economy, crush corporate earnings, and you will get a downturn. But I'm optimistic that you won't get a big wages breakout. I think wages in the US in particular will continue to grind slowly higher, and that's partly based on what you see on this next chart. This is a chart which looks at unemployment and wages growth across the major economies in the developed world from the IMF. And if you look at it, so the unemployment rate has now dropped back down to the low levels that we had prior to the GFC, but the unemployment rate hasn't really the wages growth hasn't really picked up all that much. So in the red line there is annual growth in wages across economies, and it's still pretty dormant. And that's taking in all countries, not just the United States, Europe, and Japan. And so the big issue is at the moment is, will the apparent tightness of labour markets, particularly in the United States, lead to a big breakout in wages? So far, at least, we seem to be seeing a structural break in the relationship between unemployment and wages, such that even though markets appear tight, you're not getting much of a breakout in wages. And those that have been attending our webinars in the past, this is a familiar theme that I've talked about in the past. And, you know, knock on wood, I don't think you are going to get that breakout, but for the structural reasons, globalization, competition from technology, population aging, these sort of things. So that is still a good backdrop for the global markets. Inflation under control, wages under control, central banks not needing to tighten all too aggressively. I'll talk a little bit about the markets in a minute when I get onto that. But the other key risk is, of course, is the trade wars going on. So Donald Trump is out again tweeting frantically overnight. So the issue is, will he be able to make a deal with China over the next few months? I can report that China, as you may know, that there was a lot of tension about this, and then leading into, as part of the G20 on Friday, they had a tentative agreement to try to come to a trade deal over the next 3 months, and if not, the tariff increases that the US were planning in January, which they've now postponed, will then be enacted. So Donald Trump's basically threatening China, do a deal that I'm happy with, or we'll jack up tariffs. And so that's where we are. Now, China have just come back. Market sold off partly overnight because there were some uncertainties whether or not China, was gung-ho about doing a deal as the US were, but they've just come out literally only an hour or so ago with a pretty strong statement saying they reckon a deal is doable over the next 3 months. And they are looking to do a deal with Donald Trump. Now, in terms of, I think bottom line is, I think a deal will eventually be done. It may not be the ideal deal that the US ideally would like, but I think secretly Donald Trump is keen to do a deal and strike a deal. And a lot of what we're hearing in terms of threats is essentially negotiating tactics and a lot of bluster. And if you look at what he's done historically, he's more or less calmed the issue with North Korea, at least for the foreseeable future. He struck a trade deal with Europe, and he's also renegotiated the NAFTA deal with Canada and Mexico as well. So he talks tough, but he does eventually seem to be able to settle and come to an agreement. And if you look at some of the details of the agreement so far, they have been relatively incremental changes. So a lot of it, I think, is still political theatre and posturing rather than, strenuous efforts to really fundamentally change the trading relationships. And so I think that's what we'll see with China as well. So again, I don't think that will blow up, although it's obviously having an effect on markets. I think it will die down as an issue as we head into 2019, and that itself won't be the catalyst for a big downturn in markets. It's more that the wages story and how the Fed reacts to that and whether or not wages break out. In terms of our economy, look, things are still progressing pretty well. Just got a chart there of the unemployment rate touching 5%. Growth has been holding up across a broad range of fronts over the past few years. We had very good housing construction. Business investment has been going well, particularly non-mining investment. Services sector through tourism, the rollout of the National Disability Insurance Scheme. Employment growth has been pretty strong. But there are some, risk factors on the horizon, which suggests that the RBA, despite that low unemployment rate, will be in no hurry to raise interest rates. And my base case is still that rates will remain on hold over 2019. First fundamental reason for that is wages growth. So if you look at, there's various measures of wages in there, all of them suggesting annual growth is still running only around 2%. And that's not enough to really generate inflation high enough. The RBA's targeting 2 to 3% inflation. At the moment, it's still sub 2%. Wages at that pace is not enough to help get it into that target band. So until such time as wages growth does pick up, the RBA is on hold. And again, for the similar structural reasons that I discussed in the United States, and the fact that we've probably got a bit more spare capacity in our market than the US, I don't see that picking up anytime soon. The other, negative factor hanging over the markets is the ongoing correction in property prices. Again, regular listeners of our webinars would note that I've talked about the boom in Sydney over recent years, and noted that it will eventually be a turn, and you will eventually get a cycle of declining prices, and we've certainly been experiencing that over the past year. And there's probably more of that to come. And that is going to put a downside risk to consumer spending next year. So basically, when property prices are rising, households tend to reduce their savings. They're feeling wealthier. They spend a bit more than their income, and that then goes into reverse. So that is the negative risk for consumer spending next year. And again, another reason why I think the RBA will remain on hold. That said, I don't see the housing downturn per se leading to a recession or a big, surge in default rates faced by the banks. Largely, it'll be most households will still comfortably pay off their mortgage, albeit the paper value of their property won't be worth what it was a couple of years ago. And there will be some default rates by late to the party buyers and potentially some investors, but in the main, I think most people will continue to comfortably pay off their mortgage, and you won't get a lot of forced sales. In terms of the markets, so as I mentioned, I think provided inflation in the US stays under control, I think you won't get an aggressive interest rate move by the Fed. I think they will raise rates in December. The markets now are only pricing in one further rate rise next year, which, if that was true, would be great news for the markets. But I think you're probably going to get at least, my base case is you'll get 2 more rate rises in 2019 in the first half of the year, but then the Fed will pause. With that, it suggests that 10-year bond yields, which are currently around 3% in the US, unlikely to get much beyond 3.5%. And if you look at the long run valuation of the market vis-a-vis interest rates, that would suggest the bond yields between 3 to 3.5% is consistent with the PE ratio, price to earnings ratio, close to where it is at the moment. So the US market doesn't need to decline a lot just because of valuations. I think valuations are fair given where interest rates are and where they're likely to go over the coming year. Now, in the last few minutes of my presentation, I'm just going to then talk about some specific investment ideas within that. Firstly, it's just generally technology, and just this chart to show you that since the bull market, since the GFC, technology has been one of the leading sectors. So that's a chart of the global the S&P Global 1200, so the top 1,200 stocks across the world, and the orange line there is the technology sector component of that index. So you can see technology is up, more than 5-fold since the GFC. Global stocks have done okay; they're up 3-fold, but certainly nowhere near what the technology sector has managed to achieve. And a large part of that story is the Nasdaq index. So the Nasdaq 100, as we'll hear a lot about in a moment, is a US-based index. A big chunk of which is technology, but not just technology, also healthcare and consumer discretionary, but technology, those FANG stocks, Google, Amazon, Facebook, dominate that. And as you can see, people like to talk about overvaluation and valuations in the tech sector. It's just simply not borne out by the evidence. Most of the gains, all of the gains in the Nasdaq index of recent years has been earnings led. PE ratios have remained broadly steady, and with the pullback in the market at the moment, it's only around 17.5 times earnings, which is below its long run average of 24. So if markets hold up, I certainly, this is potentially a buying opportunity in the tech sector. But again, Dave will speak a lot more about the specific opportunities of the companies in that area. The two others I want to share with you are robots and Asia technology. So another great thing, really what I'm talking about here is with the sell down in markets this year, particularly in Asia. So the fears of a Chinese slowdown has hurt the Asian market in particular, and I think it's leading some interesting value opportunities. So we have an ETF that gives you exposure to the top global robotic companies. And we're seeing huge demand emerging for robot technology across a swathe of industries. One of the principal drivers there is slowing population growth, aging populations. Getting good workers in different areas is getting harder to achieve, and as a result, there's a trend toward trying to use labour-saving technology. The next chart just gives you one example of that of Strategica Research Group. Looking at projected growth in sales in robotics and artificial intelligence over the decade to 2025. You're looking at something like 30% annualized growth in demand for robotics over to 2025, and in artificial intelligence, closer to 60% annualized growth, according to that research company. So huge underlying demand potential for companies in this area. And so our robotics it's actually trading at a PE ratio of about 21. It's had 5-year annualized growth of about 17%. Over the past 6 months, the underlying index for this ETF has pulled back about 9%. So, potentially, an interesting time. But the actual companies in that ETF I will leave for Chris to talk about a little bit later. The last one is really effectively, I just described this as an Asian version of the Nasdaq index. So in the same way that the Nasdaq gives you exposure to the top, really the top global non-Asian tech companies like Google, Amazon, Facebook, this one gives you exposure to the top Asian companies, as in Alibaba, Baidu, Tencent, Taiwan Semiconductors. And the underlying driver here is that is huge, and it's growing quite rapidly. There's already twice as many internet users in China as there are in the United States, at a time when internet penetration in China is still only half that of the US. So China's population is 4 times that of the US. So even though penetration is only half that of the US, they can still manage to have twice as many internet users. Looking at some demand projections there. So again, another research group. This is actually a research on the Southeast Asian economy, so it doesn't even encompass China, but it's Malaysia, Indonesia, these sort of countries. And you're looking at just in that region alone, e-commerce spending projected to grow something like 30% per annum in the decade to 2025. So very strong growth. And just to conclude with the next chart, again, if you look at the top global technology companies around the world, I mean, the top ones are the names I'm sure you're familiar with. A lot of the products I'm sure many of you are already using. But also in there as I mentioned, Alibaba, Tencent, Taiwan Semiconductors. So these are the type of companies that the Asia ETF gives you exposure to. Just on that, would you believe that the PE, partly because of the sell down in the Chinese market this year, also because it is a more short run volatile market, it trades at a lower PE generally than say the Nasdaq. The PE ratio for that index as of the end of October was only 11 times earnings. So it's quite interesting that valuation, and that's given you 5-year annualized growth of about 16%. With a pullback in prices over the past 6 months of about 15%. So, potentially an interesting time to consider getting some Asian tech exposure. So with that, I will hand over to David.
Thanks very much. I'm handing over now to Dave Gedeon from Nasdaq to take us through indexing in technology. Over to you, Dave.
Excellent, and thank you, David, and thank you everyone for dialing in and enjoying this great webinar. And I think the starting point that we want to go towards, especially with the recent market events and recent items that we've seen within equities, broad-based equities, technology stocks, is to try and change the focus a little bit around what do we consider technology, and really what is the technology sector as it results in, and what does it mean in terms of the broader economic story. And so technology has two of the great buzzwords for us: innovation and disruption. And really what we have seen over time is just that when it comes into broad industries, broad business models that have existed for decades upon decades, really unencumbered and unimpeded in terms of that growth march. And what had occurred was, through an amazing advancement in computing power, in data storage, and really the advancements of the internet, we have seen technology come in, create innovation, and disrupt those tried and true industries. And as a result, technology has really become the economic driver. And so it doesn't matter where you sit or what aspect of the economy that you find yourself in, you are engaged with technology. And that's a fundamental shift from where we were, really 10 years ago, let alone 20 years ago, when you think about what technology was, especially from an investing perspective. So today, if a sector is booming, if there's a lot of construction going on and a massive infrastructure projects going through, those infrastructure projects are net buyers of technology. If financials are running and banks are starting to grow and expanding their workforce, expanding their payrolls, they become net buyers of technology. So technology really is the glue which holds all of the economy together. And as a result, you've seen some phenomenal performance over time, and really what I think will be a continued growth story going forward. And I think the best way to think about it is you look back historically at what industrials used to be. General Electric, Chicago Gas, American Sugar, sort of three of the original Dow industrial companies dating all the way back to 1896. They have been replaced. They have been replaced by Microsoft, and Intel, Amazon, Apple, Alphabet, Cisco, Qualcomm. These are the modern day industrials, the industrial companies for the 21st century. There isn't a day that goes by that, whether it's in your social life, personal life, or corporate industrial life, that you do not engage with the names that pepper the Nasdaq 100. And what has been driving this growth, and what is driving the ability for technology companies to grow, to change, to successfully compete across all segments of industry, is really what I like to call the Great Deflation. And this is a chart that shows the price of dollar per megabyte of storage. So just sort of a reference point of how cheap storage has become. So if you think about what is storage, that is data. That is consumer information. It's more advanced specs and designs for building and designing projects. It is everything that we interact with on a daily basis is now cheaper and easier to maintain and manage. And as a result, productivity and capability increase, yet the actual cost to fund that increase is continuously going down. And this chart only goes from 2007 to 2018. So this is only an 11-year chart, and you have that dramatic of a drop in data costs, which are really fueling what we see of technology in life, and what are the other aspects that, if you stop and sort of pull the view back and ignore the headlines of what technology is and what are these things that are going on, and actually look at the benefits around technology. In the bottom left chart, you have the U.S. oil production. And this is just an incredible story if you are old enough to remember the oil embargo that the U.S. went through in the 1970s. If you recall the cataclysmic price moves of oil in 2007 and 2008, the United States, as the world's largest economy, was a net importer, dependent upon the rest of the world to produce energy. And today, the U.S. is now producing close to 30% of the world's energy and is a net exporter. And this is a phenomenal turnaround that's been driven by technological advancements in geology and drilling, which have allowed the U.S. to tap its natural resources and really create an immense opportunity within the energy market. Financial services, where we find ourselves today. Technology and data has been a competitive advantage that the active management community has had for decades. And over the last 5-10 years, we have seen a couple of advancements within financial services, within asset management, that have taken away those advantages. Data and company fundamentals, the basis of fundamental bottoms-up active asset management. There is no longer a competitive advantage in that space because of technology and because of data. And as a result, we see time and time again that active managers drastically underperform their benchmark and do so continuously, where there's only a very, very small minority that are actually able to beat that benchmark. We also see that with the environment. Technology within the automobile industry has been phenomenal over the last decade, where you've seen a massive increase in fuel economy across entire fleets. Obviously, the advent of electric vehicles and mass production with companies like with obviously Tesla as a great Nasdaq 100 component, and the other large auto manufacturers moving into the EV space, effectively leapfrogging plug-in hybrid technology because of the advances that we've seen within battery capacity. As a result of that, significant decrease in CO2. And so when you think about the weather, you think about global warming, we are actually working towards massive reductions within CO2. And what we see is really an advancement around technology. And so what is the ultimate benchmark for these companies? And if you want to be able to see how these names are performing and what is the best way of looking at it, well, that's the Nasdaq 100. So the Nasdaq 100 launched in 1985 as the 100 largest stocks listed on Nasdaq, and it's been the bellwether and benchmark for these names ever since. And if we look at recent market performance, yesterday included, we've seen significant volatility being added back into the market. These are declines from historical highs, and when we see these declines, what ends up coming is the fundamental story driving the reward back into the investor side. So in this chart, we're seeing in the blue line the Nasdaq 100 sales per share, or really the top line revenue growth of the Nasdaq 100 dating back to 2006. So over this 12-year period, you have seen consistent increases in top line revenue growth. And for the majority of this period, you saw the actual Nasdaq 100 price trail that sales per share growth. And what that means is that the reward of owning the Nasdaq 100 during this period was not driven by valuation expansion, was not driven by exuberance or irrational pricing, but was actually driven by pure fundamentals. And that is noted with the orange line off of the right axis, which has seen a decline in the valuation of the Nasdaq 100 over this period. So over a tripling in value, 307% price return growth over a 12-year period was driven almost exclusively by that top line growth of a near 300%. And then when you compare that against other U.S. equity indexes, and it's important to compare the Nasdaq 100 against other U.S. equity indexes because the broad-based equity indexes are in line and similar to what you see in the rest of the world, with heavy financials, heavy energy exposure, heavy materials exposure. And the Nasdaq 100 has very limited exposure to those sectors. And as a result, you've seen significant outperformance of the Nasdaq 100 compared to the S&P 500. And so when trying to gather U.S. exposure and broad-based equity exposure, the Nasdaq 100 is an excellent tool to deploy, and especially when you look back from a performance perspective. And then when you compare the performance versus the S&P, oftentimes what can come up, and you'll see this more often than not with headlines, when the market's down, it'll point to tech and the tech volatility, and really that's a result of people thinking back 18 years ago to the dot-com crash when we had sock puppets on TV trying to sell us pet supplies. But in reality, the historical volatility has been extremely similar to that of the S&P 500, where there have been spikes in the broad market due to macro events, whether it's global financial crisis, the U.S. credit rating getting downgraded, other events that we have seen in the start of Q1 2018, just yesterday in terms of a reaction event. The volatility has been quite in line. And so one of the things to look at then is the 100 that makes the index. And what that means is, quite frankly, all 100 stocks within the Nasdaq 100 contribute to that phenomenal story. And so it's very easy to keep and continue to talk about Apple and Amazon and Alphabet and the incredible performance that they've had and how big of a market cap they have become. However, what we have done from a research perspective is split the Nasdaq 100 into two: the top 50 by market cap and the bottom 50 by market cap, and then equally weight each of those indexes and create a back test going back to 2001, comparing the performance. And in reality, over this time, the bottom 50 have actually outperformed the top 50. So the smaller names have actually outperformed those larger names. And what that is showing is that there is just tremendous opportunity up and down the Nasdaq 100 from an investing perspective. And what's driving that? Well, again, it's the fundamental story. And so looking at this chart, we have two aspects. One, 10-year sales growth across industries within the U.S., and then the weights of those industries within the Nasdaq 100 and with the S&P 500. And it is not a coincidence that technology, healthcare, and consumer services have the three highest sales growth over the last 10 years. And technology, healthcare, and consumer services have the three highest weights within the Nasdaq 100. And the Nasdaq 100 has significantly outperformed its benchmark, or the S&P 500 as a broad U.S. equity benchmark. And so to drill into some of the individual names just a bit more, we have a table of the top performers year to date. This is data as of last week. And you see an interesting name where there aren't a lot of the headline names. Yes, Amazon is there. They've had a tremendous year. Netflix as well. You know, those are really headline names. But you have a couple other smaller names: Autodesk, Express Scripts, Workday, a cloud-enabled software company that competes for business service software. You know, that is a technology company. They're deploying their services via the cloud, but they're competing in a traditional work environment space. And they've been rewarded very well this year from a return perspective at 36%. And at the same time, you see that the growth in earnings year over year. And this is as of Q3, so September 2018. And again, you know, not the core headline names, but you do see a lot of different names coming in. I will point out Amazon here in terms of, you know, their recent earnings reports being very positive from an EPS perspective or net earnings side. And one of the biggest drivers on that is really the underpinning of technology as a whole, the AWS cloud service. This is a business line that Amazon has organically grown from $20 billion in revenue. Absolute phenomenal story in terms of company in the grow and drive both top and bottom line success. So focusing a little bit more on the sectors, you see the breakdown here. 56%. To there. That exposure is really impactful when you take back just prior to the end of the global financial crisis. You see the top three performing sectors over time: global tech, global healthcare, global consumer services, and also being the top three segments within the Nasdaq 100. Now, these industries aren't just growing. They're not just breakout stars that are expanding their multiple and expanding their revenue story. They're also companies who are maturing, who are expanding out from a dividend perspective. And so in the same regard of what we have been hearing, when you look at cumulative dividend growth since 2008, technology and healthcare 1 and 2, but technology is head and shoulders above all other sectors with over 240% growth in dividends paid out over this period of time. And so transitioning from dividends then into the fundamental story, the Nasdaq 100 and its performance has really been driven just by an absolutely phenomenal fundamental piece. So since 2003, so going way back, this is really pre-Web 2.0. Obviously, Facebook hadn't even been thought of yet. Google was just in a garage outside of Stanford. And taking that all the way through today, you have had a 24% compound annual growth rate with an earnings of 14% in revenue, that 20% compound annual growth rate on dividend value, and a negative 11% contraction. So an actual contraction in valuation year over year over year for 15 years. And the shift of that fundamental story in the Nasdaq 100 has just simply resulted in outstanding outperformance over other U.S. large cap indexes. And in the next slide here, we see really the graphical representation of this growth. So, you know, the great chart there, the one that kind of skews the scale quite a bit, is the dividend dollars paid out by the companies within the Nasdaq 100. So that's the actual physical hard cash. And in 2003, that was about $2 billion paid out. In 2018, we're projecting over $70 billion being paid out. And if you factor that into yield, that's a 0.1% yield back in 2003 to roughly about a 1% yield today. Now, 1% yield, that's not a high yield. I understand that specifically when you compare that to the Australian market. However, over that period of time, that yield has grown, has expanded tenfold, while the index itself has expanded tenfold. And so you've seen this just massive increase in dividends. And the other aspect is the capacity of these companies to continue to increase their dividends as they have significant cash holdings and significant growth to be able to fund out that next dividend and be able to continue out this great track record of payment. So the other aspect on technology, really the perhaps even most important aspect of tech, is cybersecurity. So cybersecurity is focused on protecting computer networks, programs, and data. We have all put in vast amounts of personal data up into the web. Corporations are running entire businesses off of the cloud. The government is now fully web enabled, being able to file tax returns through the government. And so cybersecurity is becoming more and more important than ever. It is really just now the fundamental protection of the modern economy. And without companies who are engaged in finding ways to prevent the bigger, bolder, and badder attacks, it really leaves the rest of the world vulnerable. And when you look at the type of attacks that we have seen, all right, so yeah, go back. Apologies here. You know, one of the aspects that is seen on this growth is the separation between retail and physical bricks and mortar versus online retail. And when you look at the U.S. alone, in terms of Black Friday, you know, the big sale that we have, the online purchases there of just alone are approaching $6 billion. On Cyber Monday, they're approaching $8 billion in online sales in a single day. And so you're seeing significant move online across retail as a set. So the more they grow, the more cybersecurity needs to come along, because you end up seeing a wide variety of targets on the attacks, individuals, public administration, and a wide variety of attack techniques. And so cybersecurity companies need to stay on top of that in order to be able to defend what our economic ecosystem is, because we were seeing a massive increase in the cost of cybercrime. And this chart does not include 2018 yet, where the cost will be even higher with high-profile hacks in the U.S. like Equifax and Starwood, and Starwood being the second largest attack per number of victims ever, only behind the Yahoo assault from several years ago. And so one of the aspects on this then, it becomes the indexing within cybersecurity. So Nasdaq launched an index to be the benchmark within cybersecurity in 2015. It was designed to provide a liquid, broad-based exposure, leveraging our partner, the Consumer Technology Association's expertise. And the reason why we really needed to launch this index as a benchmark is cybersecurity is a very diverse set of companies. You have technology, you have traditional defense companies, you have industrial names. And so having a good thematic benchmark is important. The other aspect on the index is typically the market cap of companies is far smaller than traditional technology indexes. And so if you have exposure to tech, whether it's through the Nasdaq 100 or through other technology indexes, you are more than likely not going to have exposure into these extremely important names. And then we look at the performance piece of the names. We have similar, strong performance, no doubt, but slightly different performance and separation from broad-based technology. So it does provide a diversifier away within the pure technology space. And so I thank you all for the time and listening. And I'll flip it over back to my wonderful partners at BetaShares.
Yeah, thank you very much, Dave, and also Dave Vastinex before that. So when looking at these new growth sectors and these new industry sectors of these industries, it's really an issue or a matter of how was an Australian investor actually going to be able to tap into them. And that sort of demand has really underpinned the innovation that BetaShares has sort of come out with these new technology and global exposures for you as an Aussie investor to actually do through a simple ETF. So I'm going to sort of reference back to a lot of the information that both David Squared today have talked about, and just give you a little bit of overview of the different ETFs that I guess they're referencing to in their information. So the first one is the BetaShares Nasdaq 100 ETF. Now, this is one obviously that we've covered in detail, and what this is giving you really is an exposure to those growth, new industrial and new economy companies that were mentioned earlier. You can see the names there in terms of Apple, Microsoft, Google. The growth potential in what's already been shown is, you look at Google in terms of growth, their third quarter revenue was 33.7 billion. And that's 21% up from 2017 through that same quarter. You look at companies like Netflix, they added around 6.9 million new subscribers in the last 3 months. So that's really sort of referencing back to where these new economy companies and how they're growing and the growth rate within them. And again, why we see them as new economy and new industrials is you use them every day. Like Dave Gedeon you mentioned before, there's probably not a day that you don't Google something or you don't use your smartphone or an Apple phone or a MacBook in your everyday life. So the more people are using it, the more of a population that's going online, these companies are of course going to benefit from that. So the fund itself trades under the ticker code on the ASX as NDQ. So the all-in cost in terms of investing in a diversified exposure across those top 100 Nasdaq companies is 48 basis points. So when you look at it in comparison to traditional active managers that also invest in this space, you're sort of looking at a third of the cost in something that's an exposure that's very closely related to what companies they also invest in. We also touched on, and what's already been spoken about, is the diversification of this particular exposure. Obviously, an Australian investor, what we get through the top 200 is a large exposure to banks and resource companies, where of course what you're getting through this Nasdaq exposure is a global exposure for one, because the companies like your Googles and Facebooks, they derive a lot of their revenue outside of the US, so they do have that true global footprint. But the other really added benefit to that in terms of diversification is the fact that it's obviously weighted to sectors where the Australian market doesn't have that much in terms of coverage. So what you've got there is a large exposure into technology, consumer discretionary, and communication services, where you compare that to something like the ASX 200, where you're not getting much exposure in that space. So that sector diversification is that really added benefit, as long as that global diversification as well. Now, as you can see, this was already touched on in terms of evaluations. David Gedeon spoke about this in terms of the historical PE where it's at, and obviously that's trading a bit below. So we won't go into too much detail there. And again, David Gedeon also covered some of the key growth rates and the fundamentals and behind this Nasdaq index. So obviously showing you those earning growths, that dividend growth, the revenue, and also that PE in terms of it coming back from its historical. So the next one is our BetaShares Global Cybersecurity, which trades under the ticker code of HACK for hack. Again, this is it really is underpinning that growth thematical theme around companies and companies both domestically and globally moving online, and governments. Look, in terms of this exposure, I believe it's really going to be one of those future defensive exposures, like I sort of touched on in terms of there's not a day you don't use Google or people are not subscribing to Netflix or using a Google or a Facebook app. these companies are going to be moving more and more online. And no matter what's happening, I guess, into that broader economy, they're still going to have to protect the data that you as a user are giving them every day. So we can see here, Netflix is just about 81,000 hours watched, 156 million emails sent every minute. And through things like WhatsApp and Amazon too, just really some outstanding numbers you can see there in terms of what's happening in a minute on the internet. So we're giving these information to these types of companies and application, and they really are going to be mandated to ensure the information we are giving them is being protected. And I guess a real key example to that is, there was the recent data breach, or the largest one in terms of the Marriott Group. There was around 500 million customers' data given away, going from date of birth all the way to passport details. A little bit closer to home, a great example would be the Federal Hotel Group based down there in Tasmania. The same thing happened to them, and also the Lowe Institute, where there was a low-level data breach there as well. So if you want to invest in that thematic in terms of that really overarching tech space that's really going to benefit from the growth of all these other tech sectors, you can do that through, as again, our hack fund. The total cost for that in terms of the MER is 67 basis points. And the companies that are sitting within that, you can see there's Syntech numbers, names you might know. Cisco, in terms of are the largest in terms of educational, in terms of that cybersecurity. And more recently, one of the newer ones is FireEye there, which was established back in 2004. Now over 4,000 customers in 67 countries. So really showing you that true growth within the cybersecurity sector. And in terms of returns, which is always a key point of investing, you can see here since inception, this particular Nasdaq index has grown around 16.5%, and over a year, even with the recent pullback and volatility, it's done around 20.86% in terms of growth. So the next one I'm going to be talking about relates to what David Gedeon was talking in terms of BetaShares Global Robotics and Artificial Intelligence ETF, and the real growth in this space, as he touched on, that aging population. And it's not the fact that robots are going to be taking over jobs from existing people. It's more the fact that the aging population is that we're going to need these robotics and these technologies to actually keep up with the demand of the growing population. So it's going to affect things like aging population, the labour cost, obviously, as there are more jobs needed. That scarcity is going to have pressure on wages, and also the performance improvements. So this ETF particularly invests in things like medical companies that are using that technology for non-invasive surgery. So there's that part of it too, and obviously with robotics, it's that precision part to what it can actually produce. So the ETF itself is the BetaShares Global Robotics and Artificial Intelligence ETF under the ASX ticker RBTZ. Currently, the cost of that is 57 basis points, so again, very, very cheap. And what it's giving you is a diversified exposure into this particular sector. It's a market cap exposure, so ensuring that the companies that are winning will increase as they do well in that particular market cap exposure. And what it's also giving you is a really pure play to these subsectors of industrial robots, non-industrial robots, autonomous vehicles and drones, and artificial intelligence. So it's really covering all aspects of robotics and AI. So again, the benefits of robotics, you get also, which is very interesting when looking at under the hood of this, you get actually some sector and geographic diversification. This is more weighted to Japan, so there's around about a 40% weighting to Japan. So again, if you're already invested in something like a Nasdaq, this is going to give that added diversification to it as well. And of course, all those things that benefit using an ETF in terms of that transparency, diversification, and simple access. And then there's the growth. Inception, you can see there's a 15.6% growth. And again, the future outlook for growth in this robotics space is really to grow exponentially over the years, as David touched on earlier. Now, the final ETF is really what you can see as, or liken it to, the Asian version of Nasdaq. What you're getting here is 4 of the top 10 largest tech companies is sitting in this particular ETF, which goes under the ticker code of ASIA for Asia. So you're tapping into that growth opportunity where Asian market in terms of it is double or triple the size of that internet users and the tech spending they do through that. The diversification factor, again, it's diversifying away from any US exposure like you may have already as an added benefit there. So in terms of the fund, looking at that, again, it's under that ticker code ASIA for Asia. The total cost for investing in this low-cost ETF is 67 basis points. Again, to the companies that you're investing in, we liken it to, Google and Facebook, because you're getting companies like Alibaba Group, which is one of the largest online retailers. Sorry, can't got my tongue there. Retailers. So you kind of can liken it to something like an Amazon, and also it has something which I believe most of you might have heard. It's Alipay. So Alipay is very much like your PayPal. But when you sort of look at the difference there, PayPal, well established, everyone knows there's around 240 active users. When you look at Alipay, which is only one part of Alibaba Group, they've got about 500 billion users. And sorry, it was 240 billion for PayPal there. So there's that massive drive to not only this being an online retailer, but giving them access through that payment system. And quite interesting in reading about this as well, even street performers or buskers, if you want to call them, they use this technology. If you want to pay them for juggling in the street, you can go up there and pay them through Alipay or WeChat, which is part of Tencent, which is the next company that I was going to sort of touch on. Then Tencent is one of those companies which is giving, it was providing access through their technology and in terms of online applications, and also WeChat, which is like WhatsApp for countries outside of China. And then there's Baidu, which is one of the largest technology companies specializing in internet service and products and AI. So again, it's very much like your Google. So I guess the comparison to that is Google's, ranked as number 6 in the world, which Baidu is number 1 inside China, I should note. So here's the performance. You can see that there. And I guess what David Bassanese mentioned earlier as well is where this is actually trading on a valuation, it's sort of just about half of what the Nasdaq's currently. So again, in terms of valuation, it's trading on a forward P of around 11. So here's some things to consider. You can read through those now, of course. It's always a reference to that. You should seek financial advice and obviously read any PDS of any fund. But now we'll pass it over back to Alan to answer any questions from everyone that's logged in today. And thank you very much.
Thank you very much, all, Dave, David, and Chris for that. We have run a little short on time, so I'll probably just have time for a couple of questions that have come through. Some that came through a few times that I could just answer myself is, are the 4 funds that we spoke about today physically backed? Well, the answer to that is yes, which means that we own each of the individual shares that we've spoken about. And in fact, virtually all of BetaShares ETFs, and in fact all of the ETFs in Australia are physically backed. The only examples where they are not is where you are doing something you can't actually physically store the underlying, such as a barrel of oil or a physical commodity. So a very, very small number of funds do anything other than own the underlying. And the other question that came through was, are these funds hedged or unhedged? So these are all unhedged exposures. Look, I think that's probably all we have time for, given that we have wanted to get you out in time for the hour. So with that, I will thank you all for your attendance. As I mentioned, you will all receive a copy of this particular presentation. You'll notice there's a number of ways you can connect with us: social media, Facebook, Twitter, LinkedIn, and of course via our subscription as well. And any questions that you have, we'll obviously respond via email as well. So look, thank you all for your time, and we'll be with you again shortly. Thanks.